Inflation, in a nutshell, is the persistent increase in the overall price level of goods and services within an economy over time. When the purchasing power of a currency declines, each unit buys fewer goods, affecting consumers and businesses alike. This multifaceted economic phenomenon can result from various factors, including excessive demand pull, rising production costs, cost push, or monetary factors. While moderate inflation is considered normal and can spur economic activity, unchecked inflation can erode savings, distort economic decision-making, and necessitate strategic interventions by central banks to maintain a delicate balance between growth and price stability. Before starting, don't forget to like and subscribe to our channel for more future updates. So, let's start. Shoe leather costs and menu costs. Inflation, encapsulated in the nuances of shoe leather costs and menu costs, unveils the practical inconveniences borne by individuals and businesses. The former signifies the increased expenses and effort involved in frequent trips to the bank, a consequence of diminishing purchasing power requiring more cash for daily transactions. Meanwhile, menu costs represent the financial burden on businesses forced to adjust prices on menus, catalogs, or price lists due to rising inflation. These tangible costs underscore the real-world impacts of inflation, illustrating how the erosion of a currency's value permeates everyday life, affecting both consumer behavior and the operational dynamics of businesses. Stagflation. Stagflation, a perplexing facet of inflation, disrupts conventional economic expectations by coalescing stagnant growth, high unemployment, and inflation. Inflation typically correlates inversely with unemployment, but stagflation challenges this norm, presenting a scenario where both economic expansion and job opportunities stagnate concurrently with rising prices. This paradoxical state creates a challenging environment for policymakers, as traditional tools to stimulate growth or combat unemployment may exacerbate inflation. Stagflation, characterized by its economic duality, unveils the intricate interplay of factors shaping financial landscapes, defying conventional wisdom and necessitating nuanced strategies for effective economic management. Core inflation, a pivotal facet of inflation analysis, distills the essential trend in price changes by excluding volatile elements like food and energy. This focused metric provides a clearer understanding of the underlying inflationary pressures, enabling policymakers to discern persistent trends from short-term fluctuations. Central banks often prioritize core inflation when formulating monetary policies, as it offers a stable gauge of the inflationary environment, aiding in the pursuit of balanced economic growth while mitigating the influence of transient factors on policy decisions. Deflation. Deflation, the antithesis of inflation, encapsulates a general decline in the prices of goods and services. While it might initially appear advantageous for consumers, persistent deflation can precipitate adverse economic consequences. The ensuing economic stagnation poses challenges for businesses, hampering production and investment. Central banks often strive to avert deflation, aiming for a moderate inflation rate to stimulate spending and maintain a healthy economic environment. The delicate balance lies in preventing deflationary spirals, without allowing inflation to reach detrimental levels, exemplifying the intricacies of managing price stability. Hyperinflation. Hyperinflation, an extreme form of monetary chaos, manifests as an astronomical surge in prices, often exceeding 50% monthly. Characterized by rapid and uncontrollable currency devaluation, hyperinflation erodes the purchasing power of money at an alarming pace. Citizens witness a frenzied race against time to spend their currency before its value evaporates. This economic phenomenon can lead to profound societal upheaval, with citizens losing faith in the national currency, savings rendered worthless, and essential goods becoming scarce. Hyperinflationary spirals pose formidable challenges, demanding urgent, often drastic, measures from governments to stabilize economies and restore confidence in financial systems. Expectations, a subtle yet potent force in the realm of inflation, play a pivotal role in shaping economic behavior. Anticipating future price movements, individuals and businesses adjust their decisions based on these expectations. If people foresee rising prices, they may demand higher wages or accelerate purchases, fueling inflationary pressures. Central to the Phillips curve theory, managing expectations becomes crucial for policymakers seeking to strike a delicate balance between stimulating economic growth and curbing inflation. The psychological aspect of inflation expectations underscores the interconnectedness of perception and economic reality. Monetary factors. Monetary factors, a cornerstone of inflation dynamics, hinge on the relationship between money supply and the availability of goods and services. When the money supply surpasses the growth of the economy, excessive liquidity can fuel inflationary pressures. Central banks, wielding monetary policy tools, influence inflation by adjusting interest rates and controlling money creation. By tightening or loosening the money supply, they aim to strike a delicate balance, preventing both excessive inflation and deflation. Monetary factors highlight the intricate dance between currency abundance and economic output, showcasing the critical role of central banks in navigating the inflation landscape to maintain price stability. Built-in inflation. Built-in inflation, also known as wage price inflation, encapsulates a self-perpetuating cycle wherein rising wages lead to increased production costs, prompting businesses to raise prices. This phenomenon reflects the interplay between labor markets and pricing dynamics. When workers negotiate higher wages, businesses, in turn, adjust prices to offset elevated labor expenses. This feedback loop, inherent in wage price inflation, can contribute to a persistent and self-sustaining rise in overall price levels. Understanding this built-in mechanism is vital for policymakers and economists seeking to address inflationary pressures and formulate strategies that balance fair compensation with maintaining price stability in the broader economy. Cost-push inflation. Cost-push inflation, a fundamental aspect of inflation, arises when production costs surge, prompting businesses to raise prices to maintain profitability. Factors such as increased wages, elevated raw material costs, or supply chain disruptions contribute to this phenomenon. Unlike demand-driven inflation, cost-push inflation results from supply-side shocks. This dynamic can lead to a cycle where inflation begets more inflation as higher prices prompt further cost increases. Cost-push inflation underscores the intricate relationship between production factors and overall price levels in an economy, influencing both businesses and consumers. Demand-pull inflation. Demand-pull inflation encapsulates the scenario where the aggregate demand for goods and services surpasses their existing supply, leading to a general rise in prices. This inflationary pressure often results from robust consumer spending, increased investments, or government expenditure outpacing the productive capacity of the economy. Demand-pull inflation signifies a growing economy, but if unchecked, it can lead to imbalances, reduced purchasing power, and potential economic overheating. Policymakers monitor and manage demand-pull inflation through various tools to maintain a stable and sustainable economic environment. And that wraps up our journey through the inflation in a nutshell. If you've enjoyed this exploration, don't forget to like and subscribe to Money College for more insightful content. Share your thoughts in the comments below about inflation in a nutshell. And stay tuned for our next exciting video. Thanks for watching, and see you in the next one.